Lyn Alden is one of the independent investors navigating the global economic landscape and answering questions regarding the path to be taken from here. According to Alden, the rate of consumer price inflation in an economy comes from a combination of 1. Money supply growth and 2. Significant changes in productivity and/or resource abundance. Periods of fast bank lending or large monetized fiscal deficits, and thus rapid money supply growth, tend to create inflationary environments, while periods of fiscal austerity and/or private sector deleveraging events, and thus slow money supply growth or outright money supply contraction, tend to create disinflationary or outright deflationary environments. Periods of technological stagnation, societal dysfunction, the need for resiliency over efficiency, war, and scarce natural resources tend to all contribute to the experience of inflation due to their negative effects on the supply of goods and services. On the other hand, periods of technological improvements, labor specialization, the sacrifice of resiliency for efficiency, geopolitical and civic peace, and abundant natural resources tend to all contribute to the experience of disinflation due to their positive effects on the supply of goods and services. As we continue into the video, take some time, hit the like button, subscribe, and make sure to drop your comments below. Enjoy. Lyn Alden released a series of tweets where she tackled the issue of debt, money printing, and deflation. According to Lyn Alden, from 1945 to 2022, the total amount of debt, public and private, in the U.S. increased from $363 billion to $93,497 billion, $93.5 trillion. That was a 7.5% annualized increase, and it was very smooth. There was only ever one time when it decreased slightly, 2009. Debt is a claim for dollars. Going into the 2008 and 2009 crisis, there were $53 trillion in claims for dollars and less than $900 billion, $0.9 trillion in actual base dollars. It was a 63x ratio. The game of musical chairs was breaking. If any one bank has liquidity and solvency problems, other banks can provide liquidity to it. The music keeps playing. If the entire banking system is comically leveraged, then bank lending seizes up and banks won't dare lend to each other. The music stops. At that point, there was a choice to make. Let most of the claims start collapsing down toward the number of base dollars, or rapidly increase the number of base dollars in the system. And we all know what happened. So, was that money printing? Yes. Because without the money printing, the IOU would have collapsed back down closer to the base. With money printing, they didn't. But it didn't create more IOU. It just preserved most of the IOU that existed. Thus, it was anti-deflationary. Now the 2020 to 2021 period was a different matter. They increased both the IOU, broad money, and total debt, and they increased the monetary base. So it was both money printing and inflationary, rather than just anti-deflationary. Greg Foss replied to the tweets saying that the debt spiral is pure maths and fiat is certain to debase. He further added a hashtag indicating that Bitcoin is the solution. Alden also posted a meme tweet describing the cycle of recession and inflation. According to the description, if inflation is too high, a recession results. And to resolve the recession, more inflation is introduced and the cycle continues. According to articles released by Alden, she projected that most central banks have a 2% annual price inflation target rather than a 0% inflation target. Over the long arc of time, prices of things like oil and meat and gold and real estate have grown at a significantly faster rate than that, while the averages have been pulled down by certain deflationary categories such as electronics and textiles where massive productivity gains were made. Policymakers are fine with the steady debasement of currency and even desire it, but don't want the rate of debasement to get out of control. That being said, within the context of the existing financial system, what should central banks do when significantly above target price inflation does happen? This has been one of the hot macroeconomic discussion topics over the past couple of years. Critiques of current monetary policy have become a modern-day form of Monday morning quarterbacking. Finance-oriented people all have an opinion on what Federal Reserve Chairman Jerome Powell should be doing differently than he is at any given time. The problem, of course, is that central banks can only affect a subset of the causes of inflation. They can influence, albeit very imperfectly, how much private sector credit creation, bank lending, happens. They can impose certain rules on their banking system, although their power to do so relative to the government depends on the jurisdiction in question. They can print money to finance their government's fiscal deficits, and in some contexts are forced to. Or they can try to do the opposite for brief periods by avoiding the purchase of bonds or even selling some of their existing bonds. In some contexts, they have the authority to monetize mortgages and/or corporate bonds and equities. And to complicate matters more, central bank independence is something that can exist in peacetime, but quickly goes away during times of war or crisis. Central bank independence in practice means that a president can't call up the head of the central bank and tell him or her to cut interest rates right before an election and other obvious manipulation. However, central bank independence does not hold up well during actual crises. A central bank will almost always facilitate monetization of government deficits during war or a sovereign bond crisis, and even if it somehow resists such a thing, it can be compelled to do so by lawmakers. In the current financial system, the majority of broad money creation happens due to a combination of fiscal deficits and bank lending, and the magnitude of those two sources relative to each other changes over time. In the 1940s and 2020s inflationary periods, most of the money supply growth was from fiscal deficits related to the war and the pandemic stimulus, respectively. In the 1970s, most of the money supply growth was from bank lending related to demographics primarily. A lot of analysts get confused or talk past each other about how to fight inflation when they are unknowingly referring to very different causes and sources of inflation. At the current time, Fed Chairman Jerome Powell is treating the 2020s, which is fiscal-driven inflation in a high public debt environment, as though it's like the 1970s, which was lending-driven inflation in a low public debt environment. He is sharply raising interest rates to try to quell bank lending, even though bank lending wasn't the cause of inflation in this cycle. Depending on how certain factors play out, it can result in some unintuitive outcomes. Raising or lowering interest rates can affect money creation and price inflation, but only in indirect ways. Some people assume that high interest rates are both necessary and sufficient to cure price inflation, but that's not historically the case. In some contexts, it's neither necessary nor sufficient. They're just one tool among a few others in a central bank's toolbox. As a more extreme example, Turkey's broad money supply and consumer price index both more than doubled over the past year and a half, with upwards of 80% year-over-year inflation at the peak, while their interest rates range between 8% and 18%. Consumer-level interest rates are higher than that, but still, it's a massive amount of inflation relative to interest rates. There's a strong market incentive for people and companies to borrow Turkish lira and use it to buy US dollars, gold, stocks, real estate, Bitcoin, art, wine, or anything that is expected to have a better 3 to 5 year return than the lira, which is almost everything. And by borrowing lira, they create more lira. Or, even if they don't or can't borrow it, they simply refuse to hold much of it, which contributes to a collapse in the lira's purchasing power, and thus higher inflation for imports, including energy. So historically, raising interest rates above the inflation rate is a key method to try to slow down bank lending and thus slow down the broad money creation that is caused by excessive bank lending. And it creates stronger incentives for entities to hold the currency, which strengthens it and can lower import costs. This is the type of environment where higher interest rates get their reputation as an inflation fighting tool, with Volcker in the 1970s being the most well-known example. The Federal Reserve's top regulatory official laid out a sweeping plan to increase capital requirements for the nation's largest banks in the wake of recent bank failures, a move that was immediately met with criticism from the industry. In a widely anticipated speech, Fed Vice Chair for Supervision Michael Barr said he planned to pursue multiple regulatory initiatives that would direct larger banks with more than $100 billion in assets to hold more in reserve, saying the recent bank failures underline the need for regulators to bolster resilience in the system. Events over the past few months have only reinforced the need for humility and skepticism and for an approach that makes banks resilient to both familiar and unanticipated risks, Barr said in a speech at the Bipartisan Policy Center in Washington. Barr had been expected to prescribe tighter rules on the sector since being tapped by President Joe Biden to serve as the Fed's bank watchdog. But Monday's remarks marked the most detailed view yet of his agenda and confirmed industry fears he would pursue a broad set of tighter requirements and also ignore their pleas for relief in some areas. The banking industry called the effort misguided and could hinder lending. The changes he outlined today fail to adequately consider the negative repercussions of forcing banks of all sizes to hold more capital than is needed to maintain safety and soundness. Higher capital requirements come at a cost to the economy, and regulators have other existing regulatory tools to manage risks, said Rob Nichols, president and CEO of the American Bankers Association. The nation's largest bank lobby said it would oppose any proposals it deemed unnecessary and economically harmful. Barr said he did not plan to overhaul the U.S. bank capital framework, but instead build on it in several ways, including by fully implementing the globally agreed Basel Bank Capital Agreement and expanding annual stress tests of banks' health. He did not offer a specific timeline for any changes, but the effort is expected to kick off in the coming weeks. We hope you enjoyed the video. Please ensure to give us a like, subscribe, and turn on notifications. Thanks for watching.